Namaste to all. I welcome you all to this first webinar for this current council year. And the topic which has been chosen by the board today is overview of accounting standards for the finalization of financial statements for the financial year 2021-22, for which few of our members have already finalized and many others are yet to finalize for the year. So hence, this webinar on a panel discussion mode becomes very, very important. And to have this discussion on a panel mode, we have none other than our past president, CA Manoj Fadnis sir, who has been the president of our institute for the year 2015-16. He was also the chairman of this accounting standard board for the year 2010-13, 3 years continuously, and then also president of CAPA from 3 years for the 2017-19. His acumen for the knowledge on the IFRS, on the Ind AS, on the accounting standards is unparalleled. It's known to all members at large. And really, it is very beneficial for all members today that he has spared his time today to share his wisdom, his knowledge on the accounting standards to the members at large. Because today, what we'll be discussing is not only Ind AS, but accounting standards, ICTS, whatever, all things about accounting standards. So I welcome you, President Sir. Along with him, we have another panelist today, CA Mohan R. Lavi. He is a chartered accountant, having more than 25 years of experience. He is from the southern part of India, Bengaluru. He is author of several books, including IFRS, Ind AS, and has been on a regular advisor to the institute and various other bodies throughout the world. I welcome Lavi sir, and I'm very sure that the whole fraternity today would be benefited by your inputs on the subject today. We have along with us the moderator for today, CA Sarika Gosang. Again, she's an, I would say, expert as well as I would say a student of Ind AS and accounting standards per se. She's a practicing chartered accountant and have been a regular speaker and contributor to the institute. And she's also the special invitee to this our accounting standard board. And we have our young, smart and dynamic vice chairman, C. Abhay Chajerji, the first time council member, first term. This is his first term from a city from Bhopal. And really, it is a pleasure for the institute to have such a council member with such a knowledge and acumen for the accounting standards. At the outset, I'll request Abhay sir to please say a few words, then we can go further.
Thank you so much, Chairman Pramodji, for giving me this opportunity. Of course, when you have speakers and panelists having Honorable Past President Manoj Fadnisji and an expert in we know about him, that how he's been instrumental in bringing Ind AS into this country and to the members and to the auditors. So I think it's a privilege and honor for each one of us to listen to him all the time. And again, our eminent speaker, Mohan Laviji, who's again an expert and, like you mentioned, being authored so many books. And it would be, again, a privilege for each participant to listen to both the eminent speakers who will share their knowledge of wisdom, which they possess for last so many years. And I think it's a great opportunity. And Sarika, of course, like you mentioned, is again special invitee. We've seen her performance and the involvement in the committee, and especially in the accounting standard board, which I'm also part of as vice chairman. So I'm sure the participant would have a very interactive sessions. Questions have already been raised before we have started, or the speakers have started speaking. So I think we can presume how.
You are mute, sir. Abhay sir, you are mute. Unmute yourself, please.
This would be really benefited to each participant who would listen to these experts. Thank you very much for giving me this opportunity.
Thank you, Abhay sir. Thank you very much, Abhay Chajerji. Friends, when we talk about accounting standards, for the whole fraternity, and not only fraternity, all businessmen throughout the world, for anything to go further, accounting is the basic concept based on which the performance of any industry, manufacturing, service industry, whatever business or profession is based upon. So accounting standards have played a very, very important role. It is a very important role in seeing that how the operations of the entity, of the businesses, professions, they end into the financial statements which can be used throughout various regulators and entities and bankers everywhere. Now, if we talk about accounting standards, currently in India, I would say there are few types of accounting standards. One, of course, we know Ind AS, which is for the listed entities and companies having net worth more than 250 crores. Then we have the accounting standards for other than the Ind AS entities, which are for the companies, which we say the company's accounting standard rules 2021, which was earlier 2006. Then we have accounting standard issued by ICI, which are applicable to the non-companies. And there are other standards which are not for the accounting per se, but for the computation and disclosures, which is for the income tax, that is income computation and disclosure standards, which have been actually borrowed from the from the accounting standard issued by ICI. So ICDS, they are 10 standards. So accounting standard issued by institute, they are 27 in number. For non-Ind AS entities, again, they are 27 in number. Then Ind AS, they are 39 in number. So having this all thing together and going further, that what are these important certain changes and what is the importance of accounting standards for finalization of the financial statements, we'll having this panel discussion, and I request the moderator for the day, CA Sarika Gosai, to please take it forward.
Thank you, Pramod sir, for setting the tone in the right context for one of the most relevant topics these days for all the corporates as well as for the auditors and the consultants, of course. On the onset of this session, please accept my warm pranam. This pandemic has at least reiterated our old custom of namaste, and we wish to continue with the same. This is actually a nice and sunny morning out here in Gurgaon, and I promise that post our session today with our distinguished, knowledgeable panelists, our day is going to be amazing further. Though in front of so much knowledgeable panelists today, I have no matching capabilities even to speak. Yet, since I have been given this responsibility to moderate today's session, therefore I feel so privileged, and I want to thank ASB for the same. I'll try my level best to do the justice to the job given to me. As the name suggests, our panel discussion today would revolve around the key considerations for finalization of financial statements for the year 21 and 22. So we would normally be talking about the topics, amendments, and other aspects relevant for this period only in general and bit of specific too, as per the time frame given to us and the relevance of the questions, of course. During the session, we might feel that a particular question or a query is mostly understood or heard multiple times in past. However, due to the fast changing scenario every day, what we have experienced so far, it is always imperative to keep pace with them and to get the experts' insights on the same. So let's begin. So now, with the permission of all my seniors out here, may I request Fredness sir to please help us understand as to what is the importance of the preface to the Statement of Accounting Standard and Framework for the preparation and presentation of financial statements while we prepare the financial statements for any particular financial year, sir. So,
thank you very much, Chairman ASB and Vice Chairman ASB, very distinguished council members, very distinguished faculty member CA Mohan Laviji, and very young dynamic moderator CA Sarika. So I feel privileged to be a part of this panel, and I'm very happy to be included in this panel and for this very interesting sessions which we are having. And to start this discussion, I think there could be no other better topic than to fall back on what is preface and what is the framework and what is the importance of this preface and framework in context of, as our Honorable Chairman mentioned, we have accounting standards, we have Indian accounting standards, and to further complicate the matter in a way, we also have this income computation and disclosure standards, although they are not meant for the accounting. nevertheless, we can't afford to ignore them. Having said that, preface is a very important document. Preface sets out the process as to how the accounting standards would be formulated in India. And the Accounting Standards Board has been following the world best procedures of having exposure drafts, having study groups, taking public comments, and then formulating these accounting standards. More importantly, what preface has, and which is important from the point of view of us as auditors and accountants and as consultants, and that is where we should keep in mind the importance of this preface, is that it gives us what is the scope of accounting standards and what is the compliance required with the accounting standards. So in context of companies, of course, we have these accounting standards notified as part of the company accounting rules. So therefore, they are mandatory for the companies to comply with these accounting standards from the point of view of preparation of the financial statements. However, for non-corporate entities, now what is the mandate for non-corporate entities to follow these accounting standards? So if you look at a partnership firm, if you look at a Hindu undivided family or any other non-corporate entity, and individuals or a body of individuals, etc. Now, there is no law which mandates that they should follow the accounting standards. Now, the preface says that, the preface to the accounting standard says that, and this is part of the announcement of the council in the sense that if an audit is carried out, and if I am required to express an opinion as to the truth and fairness of the financial statements, if the financial statements do not comply with the relevant accounting standards, then it becomes the bounden duty of the auditor to give a proper disclosure in his audit report. And disclosure does not mean qualification. If you see in the preface and the other announcements of the council, very useful examples have been given as to how you make a disclosure. And this is very practically important for most of us who are auditing non-corporate entities, maybe for tax audits and other purposes, or for government grants. We have educational institutions being audited, which are in the form of societies or trusts. So there, if these financial statements do not comply with the accounting standards, then depending on the materiality of the issue involved, we need to give an emphasis of matter or give a qualification in the financial statements. So this is what really comes in from the preface. And there are very good examples given by the ASB as to under what circumstances we need to give an emphasis of matter. So let me just pick up two examples, very common examples which we come across in our day-to-day lives. Suppose I'm auditing a professional's books of accounts under the tax audit, and the professional is maintaining accounts on a cash system of accounting. Now, cash system of accounting is acceptable under the Income Tax Act. But for a general purpose financial statement, it is a deviation from our AS1. And therefore, there is a requirement to give an emphasis of matter. Now, this is all which is flowing from the preface. And therefore, preface becomes very important for us to bear in mind when we come to this subject of accounting standards. Similarly, the next aspect which our learned moderator has raised is with respect to framework. Now, we have today for India a conceptual framework, which is more or less similar to the framework for the preparation of financial statements, but because India differs from AS in some fundamental aspects. But this framework gives the basis. It defines the different elements in a financial statement. It also makes a very clear statement that estimates are essential for the preparation of financial statements. They are recognized as one of the limitations of the financial statements without making the financial statements unreliable. So these are certain fundamental aspects which come up from the framework. Now, if you come across a situation where you are dealing with an issue on an accounting policy for which there is no relevant accounting standard or no relevant Ind AS, then you are required to fall back on the framework and look at those principles and determine your accounting policy. So I think, Sarikaji, what you asked is very important in context of setting our discussion with respect to be it AS or Ind AS. we need to bear in mind the preface and the framework for the preparation and presentation of financial statements.
Okay, thanks sir for these insightful thoughts, and I'm sure now on we would be able to better draw references from these documents while we are preparing financial statement under any framework whatsoever. Thank you so much, sir. So moving further in the discussion now, Lavi sir, may I seek your inputs on a very relevant question in today's context? And the question is, what are the different sets of accounting standards applicable in India? Though Pramod sir has already given a bit of highlights, but I'm sure participants would be willing to understand more in detail about these. So broadly, what is the current level of differences amongst them or amongst these set of standards, from the macro level, sir?
Yeah, thank you, Sarika ji. At the outset, let me just also thank the ASB, CA Pramod Jain ji, and CA Abhay Chajja ji for inviting me here. And of course, Manoj Fadnis ji, who's been a mentor, guide for me for a very long time. I still remember the AS11 when the paragraph 46A was introduced, how much of discussions we had about that. And we had quite a lot of discussion in Bangalore about that paragraph 46A. So it's been a pleasure, and welcome to all the members also. So Sarika ji, to answer your question, I think Pramod Jain ji has already taken off 50% of my burden. So I will not repeat what he has said in terms of the number of standards. We have 39 Ind ASs, 27 ASs. ASs also for the non-corporate entities. But I would just like to, sort of highlight the fact that we have got 12, at least in terms of number, there's a difference of 12 standards between the AS and the Ind AS. So you can see that in terms of classification of standards, Ind AS can very clearly we can segregate the standards on, say, for example, in terms of asset-based standards, we can say income-based standards. We can segregate those standards in terms of those particular areas as such. And so I'm not going to talk about ICTS because, as Manoj Fadnis ji said, I actually call it as increasing confusion, decreasing simplicity instead of ICTS, because I think that is what it has done to everybody here. So we'll leave ICTS apart from this. But for those members who are viewing this, I would like to re-emphasize the point which was made by Manoj Fadnis, which says that for non-corporate entities, why is this framework important and why are these accounting standards important? I think as far as Ind AS is concerned, I'll take the liberty of saying that disclosures are acting as an insurance against good accounting, for good accounting. The detailed disclosures in Ind AS are acting as a pretty good, insurance for the accounting part. May not be in terms of, the AS standards because the disclosures are much slightly reduced there. So I think the necessity to follow all those standards completely in spirit is, I think that's what I would like to emphasize. There are a lot of other major differences also. For example, we did not have a standard on financial instruments in the AS world, unfortunately, because it was only recommendatory in nature. So companies who have voluntarily adopted the AS 30, 31, and 32, they did not have a problem in transitioning into Ind AS. But companies who did not do voluntary adoption and who are only following AS 13 for investments, I think they had some sort of a major impact because of the transition to Ind AS. I would also like to mention that maybe Pramod Jain can also add on to this, that ICA is also having a project to upgrade the existing accounting standards for those who are less than 250 crores. And I really want to compliment the ICA on this, sir, because I went through the draft AS 109. I think this has to be sent to the International Accounting Standards Board. How to simplify the financial instrument standard. They have actually broken up into 3 parts, magnificently done. And that is exactly what we require for those small and medium enterprises. We don't require a 189 paragraph standard for that. So there is also that which is going to come for those enterprises below 250 crores. The upgraded AS, we can probably call them as AS, upgraded AS, which have been completely, or which is in the process of being completely done up, at least to the extent of whatever is possible as far as Ind AS is concerned. So I think these are the major things which we have to be aware of, Sarika.
Yeah. Thank you, Lavi sir. Indeed, it was really a comprehensive answer to understand the current situation from the macro level, I would say, in such a short span of time. You explained it beautifully, and we will take care of it going forward. Sir, I'll bother you again. One more question relevant in this context is also here. And please see if you could throw some light on that as well. We understand that the criteria for classification of non-corporate entities for the purpose of applicability of accounting standards was changed with effect from accounting period commencing on or after 1st April 2020. Introducing a new type of entity, which is level 4 for micro enterprises. What are these new levels now for the benefit of all of us? Can we understand all these categories and why there was a need to add one more categories as micro enterprises?
I'll first explain the criteria for those levels, because I think that is what members would probably require. And then we'll get into because actually level 4 is a residual level. What does not fall into 1, 2, 3 goes to level 4. So we need not worry about definition of level 4 as such. I think level 1 is quite easy. Listed companies or companies which have issued or in the process of being listed, banks, insurance companies, and those with the turnover in total income of more than 250 crores and borrowings of greater than 50 crores. These will basically fall into level 1 companies. Level 1 companies are level 1 only. They have to follow it to the maximum extent possible. Not too many, exemptions or abatements are given for them in terms of following accounting standards. So that those level 1 companies would invariably be under Ind AS also most of those companies will probably be under Ind AS also. So the level 2 companies, the borrowing criteria and the total income criteria has changed. It is more than 50 crores and more than 10 crores. More than 50 crores of borrowing and income and more than 10 crores of borrowing. So there you will have a few relaxations.
Lavi sir, just to add, just one point. It is not companies, because companies are governed by others. These level 1, 2, 3 are entities, so not companies.
Oh, sorry. Okay, entities. Okay, I stand corrected.
Members would be then misunderstanding that. So just that.
Perfectly valid interruption, sir. Thank you so much for that. We've got so used to using the word called companies, no? So entities. I really stand corrected. Thank you for that, sir. So the total income more than 50 crores. I will repeat the word called entity, thanks to Pramod ji, and more than 10 crores of borrowing. They will be level 2 companies. Level 2 entities. And the third will be level 3 would be more than 10 crores of total income and more than 2 crores of borrowing. They would be under level 3. Now, as I told earlier, level 4 is a residual category. What does not fall into 1, 2, and 3 would fall under level 4. And so, Sarika ji, you asked me the reason why these levels are there. I would put it in the broad level of trying to ensure that compliance with accounting standards becomes easier. I can give you one example. Say, for example, the lease standard wherein you have to put the minimum lease payments disclosure. That is not required for many of these level 2 and level 3 entities. So I think that's the part. See, in terms of accounting, I don't think anybody can give too many relaxations in terms of accounting standards, in terms of passing the journal entry for accounting. The maximum all of us can do, ICA can do, is probably give relaxations in terms of disclosures. I think that is what has happened here. And I think, entities who are in this level 2 and level 3 would definitely welcome these changes, because you see, disclosure is not only, a Word document. It involves computation also, right? So to that extent, I think they will be thankful that those disclosures have been, reduced a lot for those companies. And that is the basis on which this classification has been done.
Thank you so much, sir.
Just to very, very rightly said, Lavi sir, that the basic intent, what you rightly said, to reduce the ease of doing the financial statements, I would say. So here, two of the important points, what Lavi sir said again, that level 4 entities, various of our members are of the view that the accounting standards are not applicable, which Manoj Patni sir also explained very well. For example, AS22, we talk about the deferred tax we talk about. For level 4 entities, current tax is still required, deferred tax is not required. But all others, deferred tax is also required. So these changes, which Lavi sir has said, these are important for this disclosure requirement, what Lavi sir has said.
Yes, sir. Thank you, Pramod sir. Thank you, Lavi sir, for explaining this aspect so easily for all of us and making or helping us making our life easy going forward. So, Fedness sir, I will come back to you again to have a clarity on level 4 entities as we just discussed with Lavi sir. What are the relaxations in particular that have been provided to these entities? So, though Lavi sir and Pramod sir has already elaborated. So, if you add on to that concept a little bit more so that the small size entities or the consultants who are dealing with those entities may benefit from the discussion, sir.
So I fully agree with what the previous speakers mentioned about the need to have exemptions for the very micro entities. So we should not be burdening them too much with too complex accounting. And therefore, very rightly, what the ASB has done is now we have 4 levels as against 3 levels which existed earlier. Now, important for us to put the discussion in the right perspective is to also see what are the different limbs of an accounting standard, if I may use that word, in the sense that the accounting standard will first give the recognition principles, then it gives the measurement principles, then how you present it in the financial statements and the disclosure standards. So these are the 4 important, so to say, divisions in which an accounting standard can be classified. Now, if you take the recognition principles, so that is how do you recognize a fixed asset? How do you recognize inventory? Now, that recognition principle has to be same for all 4 levels. You can't make a change. I can't say I'll recognize something as an inventory, which does not meet the definition of an inventory. Therefore, the recognition principles will always remain the same. Measurement principles also have to be the same, because how do you measure an inventory? Can I say that I will measure inventory other than the cost which I have incurred? So no, the answer is a clear no. So therefore, the measurement principles are also the same. However, in some cases, like for instance, impairment provisions. Now, what is impairment? Impairment is if you have an asset which is, say, a power generating company has put up an asset of 10,000 crores and which has a useful life of 50 years. Now, these are the assets where you're required to determine whether there is an impairment over its useful life. And if there is an impairment, you need to make impairment provisions. Now, normally in case of a small entity, a micro entity will not be requiring to go in for such complex accounting. And therefore, however, in AS 28, for measurement also, there is one small exemption which is given, that you need not really go for complete valuations and do a discounting, find out the present value and do everything. So value and use computations are easier. So that may be just one of the very few exceptions in terms of presentation, in terms of measurement principles. However, as our chairman mentioned, and the learned speaker mentioned, that disclosures are where you need to give the real exemptions, and disclosures also require computations. Disclosure also requires certain amount of bookkeeping and recording of the transactions in a particular manner. So it is only in context of disclosures that there is a room available for giving exemptions to smaller entities. Now, one more principle we need to bear in mind is that some of the exemptions are based on the type of business and type of products which an entity deals with. So normally we'll say an enterprise which is having a turnover, which is in level 4, having a turnover less than say 10 CR, or it's a very small entity. So there you will not find too many complex financial products being used by those entities. That is the general expectations. But assuming a small businessman starts using swaps and starts using options, or starts because many people are in derivative business, we should not lose sight of that fact. Now, if somebody is using complex products, then if the business becomes complex, then it becomes essential that your accounting also matches to the requirements of your business. Otherwise, the accounting will not give the faithful representation of the transactions. So what is implied in these exemptions is the fact that because of the turnover is less, the net worth is less, these entities do not have complex products, and their accounting is simple, and therefore we can apply those exemptions. I would like to caution my colleagues, as auditors particularly, if we come across a situation where a person may be in level 4, But if that entity is having complex business products, then be careful about applying the accounting standards, because accounting standards are principle based and they are not rule based. So let's apply our judgment to the situations, and in majority of the cases we will find that those entities deserve those exemptions and we should generously apply those exemptions. But if you look at the kind of exemptions which are there now today, as our chairman also mentioned, 250 crores, 50 crores borrowings and other things. So one of the aspects which always bothers me in the company accounting standard rules, and this was there in 2006 rules and also in 2021 rules, is that it says if borrowings including public deposits are not exceeding 50 crores. That is where I think we need to be a little skeptical. If there is a company which is having public deposits, see, a private limited company is not supposed to have public deposits. A public limited company can have a public deposits and it can still be an unlisted company. Now, friends, if we are auditing a NBFC by chance and it has accepted public deposits, we should be very careful in granting them the exemptions which are given. So these exemptions are not mandatory. Nothing stops an auditor from applying his judgment and asking for more disclosures if the situation warrants. So while in most of the cases we can we can apply all these exemptions to the entities, I will also not use the word company pointed out by the chairman. So, but in case you come across situations where there's a proprietor having not turnover of maybe 3-4 crores, but if you come across him using all kinds of fancy derivatives, then be very careful in accounting. Then there are principles which have been laid down by ASB long back as to what kind of disclosures should be made. So please see that those disclosures are also being made in such cases.
Yeah. Thanks, sir, for your detailed reply on the matter.
Sarikaji, just one thing I just wanted to also tell, with the permission of Pramod Jainji and Manoj Fadnisji also. Just this is only for the members, and it's just the fact that please avail only what exemptions have been given by the ASB. Don't take your own exemptions. Just because you're in level 4, you cannot take liberty of saying that I will not do this disclosure requirement. We've seen this in a couple of cases wherein they feel that level 4 kya hoga, kuch nahi hoga, but I don't think it's we should take it at that level, because there can be complications in that also. So please be aware of that. Take only what is available and given to you by the accounting standards.
Yeah, thanks, Lavi sir, for these word of caution, and thanks, Fadnis sir, for the detailed reply. And since the objective of ICI is to introduce level 4 with the objective of easing out the applicability and disclosures, so I'm sure with this clarity we would be able to better apply or follow that objective of ICAI. Now, Pramod sir, I would like to come to you and understand about AS Rules 2021. As we all know that MC has completely replaced AS Rules 2006 with companies AS Rules 2021. What would be the impact of these in the financial statements and auditors report in the period to come?
Thank you, Sarikaji. First of all, members should be very, very clear that per se there is no change in the accounting standards. Those 27 standards which were there in Companies Accounting Standard Rules 2006, which is now replaced with Companies Accounting Standard Rules 2021. So accounting standards are same. There are no changes. However, we have to take note, because some of our members are in the habit of copy pasting. So when in the notes of accounts, when you are writing that the company is complying with the Companies Accounting Standard Rule 2006, that would be an incorrect statement. So there you have to change, because then the change has to be made in all the financial statements. Then also in the auditor's report, when you're writing that the companies are complying with the accounting standards, Companies Accounting Standard Rule 2006, as noted by section 133 of the Companies Act, again that would be wrong, because that is not correct. Then it has to be replaced with 2021. Now this I feel that members might miss. So that's why I'm emphasizing. Please take care, though the accounting standards for the non-Ind AS companies here would amend. It would amend. For non-companies, it is same. But for companies, the Companies Accounting Standard Rules 2006, The terminology 2006, the year has changed to 2021. So make that necessary changes in the financial statements and auditors report. One thing more important I would like to share with all the members what Manoj Fadnis sir and Lavi sir has said about the various levels 1, 2, 3, 4, as well in the case of this company's accounting standard 2021, where there is a categorization of SMC and non-SMC and claiming of certain exemptions for the disclosures. So there is a paragraph mentioned in the accounting standard issued by ICI as well as the company's accounting standard rule 2021, which says that, I'm taking the case of a company where it says that if a company is an SMC, then they have to specifically mention a paragraph where they are availing of those exemptions. Then you have to mention that paragraph which is given in that general instructions in the notes to the accounts. We have seen that that has been missing. So that is required to be given in the notes to the accounts for SMC companies and for level 2, 3, and 4 for the non-companies. So kindly take care, and that general instructions take care in your notes to accounts.
Beautifully explained, sir. Thank you so much for your reply and the guidance.
Padnis sir wants.
I must compliment the ASB for bringing out this so very clearly in this webinar, because as you rightly said, most of the members may not be aware of these changes which have been notified in June 2021, and therefore since there is no change in the standards, people may have missed, and people may likely to miss that the rules have been amended. So I must compliment you for bringing out this so very clearly in this webinar, so that our members do the right things. There's no intention of anyone to make mistakes. And this timely message going from the institute is really welcome.
Thank you.
Thank you, sir, for acknowledging and guiding us further. So I would now like to go again to Lavi sir, and we understand that the company's accounting standard rules to 2021 have been amended, and we just discussed. That has changed the definition of the category SMC. How this change is going to impact the companies in terms of applicability or disclosure or in any aspect whatsoever, sir?
Yeah, of course. I think first we need to understand what an SMC is, Sarikaji. So I think that definition is what I tried to put it out first. And I think basically what they're talking about is it should not be listed, or it should not be in the process of being listed. And that is one of the criteria. The second is it should not be a bank or an insurance company. This will take you back to level 2 actually. A lot of this will take you back to level 2 of the entities, not companies here. Level 2 entities, and here we're talking about companies here, right? And the turnover criteria is again less than 250 crores. Borrowing criteria is less than 50 crores. And of course, any subsidiary or of this company should also not be a subsidiary or joint venture of this particular set of companies. These would be defined as SMCs as per the company's accounting standards, rules 21, which has been amended in June 2021. Again, here the non-SMC companies would be those which are not falling in this particular criteria, or what not falling in this particular category here. I think the disclosure requirements have been pretty much discussed here. We have to be very specific about whether you are going to, whether you're falling into that particular category or not, and if you are, what are the exemptions available to you. We should I will again repeat what the chairman of the ASB has also said, saying that please ensure that you are in the right category. He corrected me when I said entity and company. You should ensure that you are an SMC or an entity, and accordingly avail those particular exemptions, as Manoj Fadnis also said. Please be a little bit careful on that. It is not very difficult. It's a one-time effort. I'm sure your members will be able to do it.
Indeed, a brief yet very informative answer, sir. Thank you once again. Now, Fadnis sir, need your brief inputs as to what are the key changes on an overall basis which have been brought in by AS Rules 2021. So I repeat myself, I'm talking about AS Rules 2021. Sir.
Yeah, so as our Honorable Chairman mentioned, the standards remain the same. So there is no change with respect to the contents in the standards. So the standards, fortunately, as of now, remain the same. Of course, the ASB project would, at a later point of time, bring in all India's comparable standards, and that is already a work in progress. So that point of time, we'll have many more changes coming in the standards. But the accounting standards do not change. The standards remain the same. There's a change in the definition of the small and medium company, more in line with the level 1, 2, 3, 4, which we have for non-corporate entities, because now we have 250 crores as the benchmark. So if an entity below that gets classified in this definition of SMC, so in that sense, the turnover limit has been increased. So maybe those entities, non-corporate entities, or even corporate entities which were being classified as SMC or were getting out of the definition of SMC because of the turnover, will now get that benefit in the sense that the turnover limits have been increased from 50 to 250 crores. Having said that, in most of the cases, because what we have been disclosing in the past, in the earlier years, and if that disclosure can be made available even in the current year, there is the effort should be to go in for more transparency and see that whatever disclosures can be made without additional cost, but will always be beneficial in terms of the financial statements, we should try and endeavor to do that. But otherwise, there are these levels which have been changed. So all listed entities are out, naturally so. Banks and insurance companies are out. So the words used are banks, insurance companies, and financial institutions. Now, non-banking finance companies could be covered in the definition of SMCs depending on their borrowings and depending on their turnover. But a non-banking finance company is basically a public interest entity. So where we are auditing non-banking finance companies, and many of us would be doing that. So we need to be very careful in terms of seeing that what exemptions are being granted, whether it is in the right category, as the chairman mentioned, and then we avail of those exemptions. But always be free to, as an auditor, because you, as an auditor, it is you and I which we are expressing our opinion. If you want additional disclosures to be made, you should ask the auditee to not avail those exemptions and still make those disclosures if it is not going to add to the cost of the entity. So keeping a rational and keeping a balanced view between the cost and benefit analysis, see that whatever exemptions are due are granted, but where it is possible to make disclosures, assuming you have been making disclosures in the past and the same information is available, feel free to make those disclosures in the financial statements, because it always adds credibility to the financial statements which we are issuing and which we are stamping our seal on that as showing true and fair view.
Yes, sir. So wonderfully covered overview, sir. Thank you so much again. After discussing accounting standard for non-corporate entities and non-Ind AS compliant companies, we would again like to hear from Fitness sir. What are the key amendments which are notified under the company's Ind AS Amendment Rules 2021, and how these are majorly going to impact the Ind AS compliant companies? So far we were discussing about non-corporate entities or non-Ind AS compliant companies. This specific question pertains to Ind AS compliant companies, sir.
Yes, so this is very important in terms of our finalizing the financial statements. Listed companies would be doing it before the end of May, and therefore many of our colleagues would be at advanced stages of issuing and finalizing their audit reports. So the Indian accounting standards have been keeping pace with whatever the changes are happening at the international level. And every year or on a regular basis, there are annual updates, so to say, which are made in the international accounting standards, and the ASB is keeping pace with those global changes so that Ind AS also matches with the IFRSs. Now, the level of changes which have been brought in now are not by way of introducing any new standard. So globally, it is up to IFRS 17, and what we have converged so far is still IFRS 16, that is the standard on leases. The IFRS 17, the corresponding standard is Ind AS 117, which is on insurance contracts and which is yet to be notified. So that's a separate chapter. So as of the amendments brought in are not to bring in a new accounting standards or new IFRS Ind AS on the statute book, but it is with respect to the annual changes or the annual improvements, as they say, annual improvements to Ind AS. So corresponding with the changes which have happened globally, some of the changes are that the new conceptual framework for the purposes of preparation and presentation of financial statements has been notified by the institute, and it becomes applicable for the accounting periods from 21-22. So wherever there has been reference to the earlier framework for the preparation and presentation of financial statements, now gets changed to this conceptual framework for financial reporting, and even the Ind AS recognizes that this is a conceptual framework for financial reporting under Ind AS conceptual framework issued by the Institute of Chartered Accountants of India. The conceptual framework is not notified by way of rules. Conceptual framework still remains as a document issued by the ASB and the Council of the Institute, and that gets recognized in the even through these amended Ind AS notified under the rules. Then there are other changes which I can quickly refer to is with respect to contingent liabilities. So in case of business combinations, where you on the date of acquisitions you have certain contingent liabilities, and even if you feel that there is a remote possibility of the outflow of resources and you do not recognize that as a contingent liability and you do not disclose that as a contingent liabilities. Now, under some of the situations in business combinations, you may be required to take note of those contingent liabilities which existed in the terms of acquisition on the date of acquisition of which is made in that business combinations. So the amendments are more with respect to disclosures and not with respect to making major substantive changes in the accounting. And therefore, these annual improvements, though they may not be very significant or may not be having very significant impact on the audited financial statements of March 22 in terms of their impact on the P&L and balance sheet. However, as auditors and preparers, we need to make a note of what changes have been made. And to the extent you have a reference which is being or anything additional disclosures which are required to be made in terms of these annual improvements, we need to take note of that and do it. Yeah. So many changes, but I would say still important for the auditors of listed entities to make sure that they have gone through these and to the extent they are applicable in their respective audits to implement them.
Yeah. Thank you so much, sir. I'm sure along with me, all the participants would have a better understanding on these changes going forward, and they would be in a better position to apply these to their financial statement preparation. Pramod sir, now we would want to get a clarity on a very specific question, which I'm sure participants would also love to hear about. What is the specific requirement and disclosure requirements in particular with respect to non-compliance of accounting standards for or Indian accounting standards for different classes of companies, sir?
Thank you, Sarika. Very rightly, yes, that financial statements should be compliant with the accounting standards. But what happens when they are non-compliant? One of the important points is that auditor, when he is issuing his auditor's report, a specific question has been asked through the Companies Act, Section 143, where the auditor has to report that what are the non-compliances of the accounting standards, whether they are Ind AS based or non-Ind AS based. So auditor there, first of all, has to disclose what are the non-compliances of the accounting standards or the Ind AS, both. Now, there is another duty cast by way of Companies Act 2013 amendment. Section 129 of Section 5 says that in case the financial statements are non-compliant with the accounting standards, then the notes to the account, the financial statement should state the deviation, the reason for the deviation, and the financial effect of that deviation, if any. So that has to be given in the notes to the accounts, which I feel that sometimes is being missed. And if that non-compliance, the deviation, the reason, and the financial effect is not given in the notes to accounts, then again the auditor will have to report in the auditor's report. In many of the cases, what happens for the non-Ind AS compliant companies, Say for employee benefit expenses, AS 15, they don't get the actuarial done. So what are the reasons? What is the deviation? What is the financial effect? That has to be given in the notes to the accounts and then reported in the auditor's report also. Non-compliance with accounting standard, the penalties are there on the companies under the Companies Act, right? 129 for all those. But for the disclosure for the non-compliances, I have to see that the disclosure is made in the notes to the accounts. Again, repeating, what is the deviation? What is the reason thereon? What is the financial effect, if any? And in the auditor's report, auditors have to see, they have to give their opinion whether it is compliant with accounting standards. Yeah, anything which Fadnis or Lavi sir would like to add on that? Right.
I think, sir, you have covered it very rightly, and non-compliance by particularly non-corporate entity is somewhere where the auditor has to take a judgment and see that the non-compliance with the relevant accounting standard becomes either a matter of emphasis of matter or as a matter of qualification.
Great, sir. Thanks for your replies, respectively. In continuation, one more question to you, Pramod sir. Is compliance of accounting standard mandatory for non-corporate entities as well? Though we have spoken about it earlier also, but that answer might have got mixed with the others since we were talking everything together. So specifically, what if the same is not complied by those non-corporate entities?
Thank you, Sarika. That has been very aptly answered a few times by our past President Manoj Fadnis sir. Now, just to state one thing very importantly, because most of these non-companies, one of the things which our few of our members might miss out is that in the case of limited liability partnership, there is an independent auditor's report which is to be issued. So that non-compliance has to be reported into that independent auditor's report. But in the case of other than LLP, so say sole proprietorship partnership that you are doing businesses or profession, and the tax audit is required, and then they issue Form 3CB and 3CD. So a question arises where to give this observation, where to give this emphasis of matter, qualification, or other matter, whatever it is to be given. Now, one thing but members have to take care that when we talk about a tax audit, it is not merely Form 3CD 44 clauses. It is the audit of the financial statements where the auditor has to give true and fair view of the balance sheet and profit loss also. It is a pure audit process for the whole financial statements. And that the true and fair view has to be given in Form 3CB, para 3A. So whatever are your observations for non-compliance of accounting standards, say non-corporates, non-companies, they 99.99% don't comply with AS 10. They don't have PPE at the useful life and then gross block, depreciation block, net block, or asset-wise derecognition, you group the profit loss. It is done on WTV basis. So that non-compliance has to be mentioned in para 3A of Form 3CB. So non-compliance of accounting standard, as rightly said by Fadnis sir, is not mandatory on the non-corporates, but it is mandatory on the auditors. That when they audit, they have to see that the accounting standards are complied with. So if they are not complied with, mention where para 3A, where you give true and fair view of the financial statements in Form 3CB. Please don't hesitate. Don't think that we will write so some qualifications, observation is there. The client would, if we don't do the correct audit, the audits, there is no purpose of audit. Let us be very frank. So let us see that and mention that appropriately, disclose that appropriately, or our reporting should be appropriate out there. Thank you.
Thank you so much again, sir. Fadnis sir, the topic which I'm going to touch base now always scares me too personally. As we all are aware that ICI has issued a revised version of guidance note on accounting for derivative contracts, which was revised in July 2021. Is this guidance note applicable to all types of entities, even if they are applying Ind AS? That's my question, sir, precisely.
So India's compliance, I mean, a very, very useful question, because derivative accounting and this guidance note has been serving a very useful purpose since, as our chairman and the learned speaker mentioned, that we do not have a standard on financial instruments in the AS, and what came in as AS 30, 31, 32 could not be notified because the basis of AS 30 was IAS 39, which itself got replaced to IFRS 9. So that is the historical background why we don't have a standard in accounting standards on financial instruments. Now we have a standard AS 30 on investments, and that really takes care of the financial instruments, so to say, which is otherwise covered in Ind AS 109. Now, because AS 13 is mandatory, so AS 109 principles cannot be imported for other than Ind AS companies. But cash flow accounting or the hedge accounting, which is given in Ind AS 109, and there are 3 types of hedge accountings which have been given, and the accounting for the derivatives, to the extent they do not conflict with the notified accounting standards. So the notified accounting standards earlier were the standards under 2006 rules and now 2021 rules. So to the extent those principles do not conflict with the notified accounting standards, they have been brought in by way of a guidance note, so that the guidance is available and the correct accounting is done. So that was the purpose why this guidance note on derivatives was originally issued and now subsequently revised last year. And it is good that these documents are periodically revised because there are certain changes in the underlying transactions. So insofar as the guidance note is giving a guidance, so when a guidance note is prepared, there is more room available in terms of giving more specific guidance. Accounting standards by their very nature are principle-based standards and would give a macro position laid out broad principles, but will not give specific guidance. That is not the objective of an accounting standard. But in a guidance note, there is more specific guidance as to how to apply those principles of the accounting standards to a particular situation. Now, that guidance note, if it is to be applied in the context of Ind AS 109, Ind AS companies, the principle that has to be borne in mind is that to the extent that guidance note does not conflict with the Ind AS 109, you can apply that guidance in terms of Ind AS companies. But of course, where what is given in the standard will always prevail over what is given in the guidance note. And that is also something which comes from a preface to the accounting standards, that accounting standards statements are at the level 1, the guidance notes, and then the other documents issued by the institute. So guidance note, what we should remember is guidance note, compliance with a guidance note is not optional, while compliance with accounting standards is mandatory. If there is a guidance note on accounting for derivatives, and if a company is not applying that guidance note, then the auditor is required to see that what is the impact, why that guidance note is not being applied. And he has to document those reasons, whether it is going to affect the truth and fairness of the financial statements. And if yes, then non-compliance with guidance note will also become a subject matter of qualifications. So the guidance given in that standard that on the derivative contracts basically culls out the principles given in Ind AS 109, but all that cannot be ipso facto applied in context of Ind AS companies.
Awesome. So thanks for providing the clarity. That was extremely useful in the context of derivative contracts and applicability for Ind AS compliant companies, and that will also, give me some ease out breathing going forward when I apply this. So now, if we try and understand the financial statements of a particular question or a company, as an investor or readers of the financial statement, what are the key accounting standard or Ind AS which are always in focus to get the pulse of companies and their performance for a particular year? Lavisa, would you like to address this query for us?
I would always like to pass on questions to Manoj Fadnis, sir, but I will take this one, no problem. It's always a pleasure to pass on questions too, but I'll take this one, madam. Yeah. So yeah, Sarika, see what happens now is that one is, of course, we will all the India standards are mandatorily have to be followed, right? As I told you. So there's no question of in fact, companies have to give an unequal statement that, they're following all the India standards. But since you asked me specifically about from an investor's point of view, I'll keep my discussion only to that, right? And there are some standards in India which you can call as very heavy standards. When I'm saying heavy, I'm not in terms of weight. I'm talking in terms of the criticality to the enterprise. I can immediately think of PP, India 16. I can think of those asset-based standards. 109 is definitely a very heavy standard. But I think in recent past, India 115 and 116 both have had a very significant impact on the financial statements. Now, India 115 and 116, I would also welcome the views of Pramod Jainji and Manoj Fadnisi also on this. But I've got a little bit of a note which says that most of the key audit matters, which I see in companies reported in the auditor's report, are on Ind AS 115 only. Many of companies, a lot of companies have got Ind AS 115 as a key audit matter, which obviously the auditor is talking about what are the risks faced and how the risks have been addressed and all those things. But if you look at it from an investor's point of view, and this is revenue recognition, so he's definitely going to think what is happening here, because he may not understand the fact that key audit matter is not a qualification, it is not a negative comment, it's just a risk which is being faced here. So I think how you write that key audit matter, how it is sort of postulated and what response is given becomes a very important thing, because revenue recognition, as we all know, is very important. And in recent times, we are seeing a lot of issues on revenue recognition in many companies. I'm not getting into that, but I would definitely think that 115 would be a very important standard. Since 116 has changed the concept of how leases are presented, bankers, investors, everybody would be very keen to know what is this, right of use asset which is coming. In fact, I'll repeat for the benefit of the members something which the past chairman of the IASB answered when somebody asked him, "Why are you complicating leasing so much?" He said, "It's a very simple thing. I'm debiting to P&L account here. Why do you want to complicate it so much? Right of use asset, liability, depreciation." He was talking from the point of view of income tax. How can I go and explain to my income tax officer that I am depreciating an asset which is not with me at all, or which I have not purchased, right? So he had a very different response. He said that one day I want to fly in an airline which shows the aircraft as an asset in his balance sheet. He said that is the reason why I have brought in this standard. One day I want to fly in an airline which shows the aircraft as an asset in his balance sheet, because most of the aircraft is going off as debit of lease rentals. So apart from 115, 116, 109, and of course, I would definitely look at those asset-based standards. I think those are extremely important from an investor point of view. But more than that, Sarika, what I think is that in case investors are not doing it already, I think they should look at the disclosures in Ind AS. The disclosures give more information than the financial statements in Ind AS. Especially, disclosures like business combinations, they are very intense. They give the pulse of the company. They know what the company is doing, why they've acquired a particular company. So for an investor, I think apart from these heavy standards, he would definitely have to look at the disclosures in detail. That really help him a lot to get an idea about how the company is performing.
Yeah. Thank you so much for elaborating this concept for us, sir. This will definitely help us going forward. Now, the next question which comes to my mind is how disclosure of accounting policies, which is somehow related to the previous question only what sir just mentioned. So the specific question which I want to raise is how disclosure of accounting policies determines the quality of a financial statement for a particular company, and can we broadly categorize these disclosures into three categories, which we usually know with the name of must have, should have, or could have categories. Fadnis sir, request you to please share your insight to unfold this answer, please, for us, sir.
As I said, the standards are meant not to give comfort or convenience or to the preparers and to the auditors. The standards are meant for the investors. And the purpose of all the standards is so that the investors get the information which they are seeking for from the financial statements. And therefore, as Mr. Lavi mentioned, the fact that there are certain very heavy standards like 109, 116, as he rightly pointed out. So these are the standards where which has changed the accounting, but at the same time has brought in a lot of information to the financial statements. So one of the standards is fair value. Now, fair value is something, it's not, fair value does not mean anything and everything can be brought in the books of accounts. There are principles, as we know, under India is 113, and there are levels of fair valuation, whether it is level 1, level 2, level 3. Now, to what extent level 1 is used or level 2 is used or level 3 is used, as the learned speaker mentioned, this is all disclosed in the financial statements by way of notes. And therefore, these are the areas where the investors should be looking into more carefully to understand what is on historical cost and what is on fair valuation. Now, there is always a trade-off between fair value and the historical cost. Historical cost is always reliable. You know what is the cost you have incurred. But historical cost at times is not relevant. And fair value at the same time could be relevant because it is giving you the current prices. But there is always a question of its reliability. It's not the cost which you have incurred. It is an opinion. So therefore, there is a trade-off between relevance and reliability, as we say. And these are matters which affect the opinion of the investors when they look at the financial statements. So when the Ind AS started, people were confused as to what is the other comprehensive income, what is going in the other comprehensive income, and is something being camouflaged in the other comprehensive income, because there were companies which had profits in the main profit and loss, and they had negative balances being carried in the OCI. So people, the investors, had confusions as to what is going in the OCI, and is the company trying to hide some information which is going in OCI, which was certainly not the case. Now, these are matters where the accounting policies for an investor who is a learned investor and who wants to understand the financial statements would actually should go through those accounting policies and see what are those policies and what are the notes given in the financial statements, which will enable that investor to understand the contents of the balance sheet and the profit and loss and the cash flow in greater detail. So if you say that if the accounting policies are to be bucketed into the different categories, as you said, must have and should have and could have, well, whatever is there in the financial statements, the contents of your financial statements, you must have an accounting policy describing how that transaction is being recorded. And really speaking, the accounting policies, if you read 10 different balance sheets, you might see that the accounting policies are so well written and so well edited and so well drafted. But it is the implementation of those accounting policies which actually determine the quality of the financial statements. And that is where the role of the preparers and the auditors really comes into play, to see that those accounting policies have been actually followed in the preparation of the financial statements, and the disclosures are made which are not just for the sake of disclosures, but which are giving substantive information about the contents of those financial statements. So must have, if you put that category, anything which is there in your financial statements, balance sheets, you must give an accounting policy. Now, accounting policies apply to material items. So all material items you must identify and see that if it is there in this year or in the past year, or you expect it to have in the near future, you have accounting policies which are properly written down and which are properly implemented. So that is a must-have. Now, should have is and could be very subjective. If you don't have any transactions of a particular type, but believing that you may have it in future, you still want to give an accounting policy on those transactions, you're free to include them in your accounting policies. But one must always ensure that there is no overdose of information, because that is also said to be bad. But at the same time, whatever is critically important should not be shied away and should be properly disclosed.
Lavi sir, Pramod sir, would you like to add to what sir just said? This is your experience.
Pramodji?
No, sir. Pandit sir has very rightly said. Nothing more to add, sir.
Very good. No, I also don't have anything in particular to add, apart from the fact that, as he was saying, whatever is your significant part of your financial statements, I think it always, you have to follow it up with an accounting policy. It's not that, and as Fadlisi correctly said, of course, materiality is a concept and there is a threshold of materiality which is given also. But, and I think one word of advice, if I may give it to all the members present here, would be that, as Pramodji also saying, we are very, fond of doing Control C, Control V, even in terms of accounting policies. But I think if I look at the, the actual intent behind Ind AS and you look at the disclosure, say, for example, performance obligation, you just can't define what is performance obligation as Ind AS 115. Maybe for your company, what is that specific performance obligation? Is it a warranty cost? I think that should somehow come out in your accounting policy. I think you would have to give a little bit, one level more of detail than what we are doing right now. I think that is what I would like to add on to this.
Yeah. Great summarization, sir, in very few words. Thank you so much. So coming next in the row is how errors and prior period items treated under AS and Ind AS regime now. And what is the basic differences between the two sets of accounting standards? Fedness are requesting again you to share your views on the same, please.
A very important issue which you have raised, Sarikaji, and that really shows how the accounting has evolved over a period of time. So prior period items, when we define the prior period items, is not different when we look at the AS5 and what is given in Ind AS 8. But the fact is how it is accounted for. So traditionally what we have been doing is that if there is a prior period item, we make a disclosure of that prior period item on the face of the financial statement. So assuming that there are certain, say, salaries or certain expenses of the previous year which have not been accounted for in the previous year, and it is a material item, you account for that in the current year, but you make a disclosure that my accounting, this item which is included in my profit and loss statement is actually not pertaining to this period, but is pertaining to the previous period. So the user of the financial statement understands that, okay, the profit for the year given here is so much, and this has to be adjusted for so much of amount of expenses which actually pertain to the previous year, or so much amount of income which does not pertain to this year, but actually pertains to the previous year. So the disclosure is available, the information is available, and then the investor is supposed to make best use of that information. Now, as the capital market developed globally, so people started asking that why should the investor make those adjustments? Why can't the preparer themselves, when they say it is a prior period item, why can't they themselves make those adjustments? And therefore the thought process changed when IS 8 got issued, and that is what is Ind AS 8, that if you have a prior period item, so if your expenses to the last year were understated, you don't disclose those prior period expenses as current year's expenses, but you include them in the comparatives of the previous year. And then you work out a profit for the previous year and a profit for the current year, and you give what is the earning per shares and other information which is required to be disclosed. So the burden of making those adjustments, which was earlier on the investors or which is on the investor under AS5, now shifts to the company. And under Ind AS 8, the prior periods are required to be adjusted in the previous year's column. Now, the practical aspect about this is that it is not that you go and reopen the last year's books of accounts and make accounting entries in the previous year, because the previous year's books of accounts are closed, the financial statements have been approved by the shareholders, the returns have been filed with the registrar of companies, so the accounts are closed. Under the Companies Act 1956, you could not even reopen the financial statements. Now under the 2013 Act, there is a NCLT, you can go to the NCLT voluntarily, or the regulators can go to the NCLT and have the financial statements reopened. So what is envisaged under Ind AS 8 is that if there are prior period items, which could be item of income or expenditure, you present it in the previous year's columns, and if it pertains to a period even before the beginning of the last year, then you prepare an opening balance sheet and make all adjustments in that opening balance sheet. So that is the framework under Ind AS 8, whereas under AS 5, all we do is make a disclosure and we stop at that point of time, and then we expect the users to make their adjustments.
Yeah.
Now,
Thank you so much.
Yeah, one more point I would just like to caution my friends is the downside of what is happening under Ind AS 8 is the company discloses that this is a prior period item, and you say it is a material item, therefore you have disclosed it. Now, today, the practical reality is registrar of companies are picking up such balance sheets and issuing notices for the previous year that you admit the previous year's financial statements are not
incorrect.
in fair view. So while you have rectified in the current year, the previous year is open for inspection, and it is possible that the registrar may take you to the NCLT and may ask you to reopen your financial statements of the previous year. So while if there is a prior period item, you don't have a choice under Ind AS and you have to show it separately in the previous years, but that actually adds to the requirement or the obligation to see that all items of income and expenses are properly accounted for during the year, and you don't miss out anything which is there for a previous year.
Okay. Thanks for sharing the insights, sir. I'm sure listeners will now have better clarity on the subject matter. Lavi sir, now I would like to ask a question specifically on a topic. While most of the companies have already, who were already required to adopt Ind AS, have already done so with time, except for a few regulated companies, as we know. Then what is the remaining relevance of Ind AS 101 going forward for rest of the companies, sir?
Okay. Sarika, you're giving only the difficult questions to me only. I'm just joking. Don't worry about it. Okay. Yeah. So as the listeners would probably know, Ind AS 101 is a one-time standard to be applied only once when the company is transitioning to Ind AS for the first time. You cannot revisit the standard, every time. So it's introduced only, it's done only once. It's implemented only once. And Ind AS 101 says that the reason why it has come out is because they wanted a suitable starting point to convert to Ind AS. That is why the concept of the Ind AS opening balance sheet came in to smoothen the process of Ind AS implementation, if I may use the word. And then, of course, you've got the previous year comparative and the Ind AS opening balance sheet. Now, for those companies who have already transitioned, there is no problem. They will not revisit the standard again. But of course, in a few cases, we are seeing that a lot of mistakes were happening on transition. So how do we rectify those mistakes? We cannot rectify those mistakes by going back to 101 again. We'll have to use Ind AS 8 probably for that. As Manoj Vadnesi correctly said, we'll have to probably go back and do it under Ind AS 8 under the prior period item standard. But there are a couple of other things which are relevant in this context, Sarikaji. One is, of course, as we know, banks, insurance companies are still not on the Ind AS roadmap. Right? They're still not on the Ind AS roadmap. They will come in probably at some point of time in the future. Ind AS 101 is going to stay there for the simple reason that when these people transition, they require to have a transition standard. It's not going to go away. It's going to be there only. The other thing which I think both the IASB and the ICA are doing pretty well is that whenever a new standard is issued, for example, 115 and 116, both have transition provisions. So even there, you need not again fall back upon Ind AS 101. You don't have to do it because you're not implementing each standard for the first time, right? Because the transition provision is there, and the transition provisions always give the option of doing as per Ind AS 101, adjusting to opening reserves and all those things here. So while the standard is going to remain, it will not be relevant for those companies who have already transitioned. Those who are going to transition, they would definitely have to, follow this Ind AS 101. That would be my response.
Thank you so much.
Lavi sir, here, one thing before Padnesar, my question out here. Whether it will not be still applicable. Suppose there is a company to whom Ind AS is applicable and it invests into a company and that becomes its subsidiary, then that would not be in the transition period. I don't know. Just my question.
Sorry. A voluntary adoption, you're saying?
No, sir.
No, not voluntary. There is an Ind AS company which makes an investment into another existing company which was not following Ind AS. But pursuant to the investment, it becomes a subsidiary. So then Ind AS is applicable to it. So
then they will have to. Then they have to do it for the first time. Yes. Yeah. Correct. Yeah.
So those cases could be there. Sir wanted to add.
I agree with this example which is given that there is a listed company which makes an acquisition and the acquiring company becomes a subsidiary. So because it becomes a subsidiary, it now is required to convert to Ind AS. And Sarikaji, we have a large number of public limited companies, private limited companies, which are not on Ind AS for the reason that they are below those threshold limits. Now, at some point of time, they will cross those threshold limits. At some point of time, they may go for public listings. And therefore, they will require this Ind AS 101 to transit at a later point of time from AS to Ind AS. As Mr. Lavi mentioned, that companies which have already transited to Ind AS, now the transitional provisions are being incorporated in the respective standards. So 115, 116 themselves have transitional requirements. When the Ind AS came in 2015, at that point of time, the transitional requirements were all put in Ind AS 101. Now that you have a substantial number of companies which are already on Ind AS and new standards come in, so you don't have transitional requirements being put in 101, but they are being put in the respective standards. So this is a process of evolution of the Indian companies into Ind AS and getting integrated with the global reporting standards.
Yes, sir. So for my own sake, if I could summarize the entire position related to 101, it would be like this. If a company has already transitioned to Ind AS, they will they must have once applied it, they will never apply it. They will apply respective transitional provisions of the new standard, that is one. Secondly, if a company is covered in such a group which is under the Ind AS regime for the purpose of consolidation of financial statement, they will have to adopt Ind AS, and therefore 101 will once be applied to them. That is second. If a company gets covered under any threshold limit which is applicable for Ind AS compliant companies, or they get listed, then they have to apply. Or largely, if a company is a regulated entity wherein the Ind ASs are not applicable, like banks and insurance companies, then they have to apply. So these are the four different scenarios, sir. Am I correct?
Absolutely.
Okay.
Yes.
Thank you so much, sir. Now, moving to fairness, sir, again, I will bother you again and again. That's my duty today, and I will not apologize for the same too. So, how the business combinations, including amalgamations, being accounted for under AS and Ind AS regime going forward? So, to have the better clarity between two sets of standards, sir.
So the standard on amalgamations, our existing standard AS 14, and if you compare that with Ind AS 103 on business combination. So business combination is a standard where which goes into the way the business has been acquired, and then it gets accounted in the financial statements. So say a company is acquiring another business, it will actually fair value all its assets, fair value all its liabilities, and then decide what is the right price that I need to pay for this acquisition. Having determined that right price, then they might even add some more thing which we call as goodwill for the purposes of acquiring the company. Now, under Ind AS 103, what happens is when you have fair valued all assets and you have fair valued all your liabilities, the goodwill which you have as a residuary amount will be less as compared to a situation when you apply AS 14. So AS 14, you don't really go to that extent of fair valuation of all your assets and liabilities, although the principle is the same. But Ind AS 103 has greater requirements in terms of fair value, even those intangible assets which the acquirer may have considered but may not be appearing in the financial statements of the acquiring companies, and so on and so forth. So the requirement under Ind AS 103, broadly speaking, is more extensive than what is covered in AS 14. So the resultant goodwill which comes in under AS 14 and Ind AS 103, the goodwill which would be there in 103 would be less as compared to what you might get in AS 14. Now, AS 14 says that the goodwill which appears on as a result of amalgamations is to be written off over a period not exceeding 5 years. So you can write it off in first, second, third, fourth year also, but it says not more than 5 years. Whereas goodwill, which arises under business combination, is not to be amortized, is not to be written off, but it is to be tested for impairment on a year-to-year basis. So I would say the fair valuation principles which are used in 103 are more in line with the manner in which the acquisition is done. So you give importance to how you acquire a business. So what are the intangibles which you have seen? What are the items, strengths which you have seen in that company? How much price you would like to pay for that? So this is all the information which the investors want to know. And that gets more properly accounted for and properly disclosed in the financial statements. So today, one of the mega mergers which we are looking forward to, and as students, as all of us are students in this subject, is the merger which is to take place between HDFC and HDFC Bank. It is one of the biggest corporate mergers in the Indian corporate scenarios, which is being in the media of last few weeks. And I'm sure these are all good companies which come. So these are the mergers which we should look at, and how the accounting is done, how the disclosures are done, because these are something, these kinds of mergers don't happen on a year-to-year basis. So when they are happening in the recent times, this is the right time for us to look into those financial statements as students, as only students, to understand how the information is being disclosed, how the different aspects are being complied with. Then 103 also talks about reverse mergers. So if you recall, ICICI Bank as the parent merged, ICICI merged with ICICI Bank. It was a reverse merger. The holding company merged into the subsidiary. So 103, the standard on business combinations, is more dynamic in that sense as compared to AS 14, which was a standard written maybe 30-40 years ago. And therefore, because of the changes in the circumstances, changes in the businesses, the complexities of businesses, as we say, 103 is capturing the essence of those business transactions in a much better way. But if you look at 103, one of the good additions which is there in 103 is, and that is what our institute and ASB has done, is we have an Appendix C, which gives business combinations under entities having common control. So which actually goes back to AS 14 and picks up the principles given in AS 14, which are put in that Appendix C to 103. And to that extent, AS 14 and Appendix C are more or less similar, because if you have two subsidiaries which are being merged into one entity, or then you don't really require to do a business, don't really require to do fair valuation. You can just do the pooling of interest method. So in that sense, 103 and AS 14 are different in their approaches, are different in the way we finally have the accounting. And 103 is more business oriented, so to say.
Sure, sir. Thank you so much. Lavi, sir,
one thing out here. But sir, here when you talked about HDFC and HDFC Bank merger, just a simplistic question. HDFC may be following Ind AS, HDFC Bank may be following non-Ind AS. So what will happen post merger? Very.
So, very interesting situation. And as I said, as students of this subject, this is what we are looking at, how the evolution takes place. Earlier, there was a merger of Air India and Indian Airlines, which was one major merger between a holding company and subsidiary company. And today, this is another very large merger which is taking place. Now, and as you rightly said, banks are still not on Ind AS. Banks are not following Ind AS. They are expected to follow at some point of time in future. So these are actually the issues which will come up, which all the preparers will have to look into very thoroughly. And maybe many of them will come back to the ASB for your guidance on these subjects.
Yeah.
Yes, sir. I think we'll have to go a little quicker now, because for the benefit of participants, we have, since this subject matter is quite vast in itself, so we have to take a lot of questions still on the row. So Now, though the question which I'm going to raise now may not be relevant to all the businesses, but may be very important for some of the specific entities. So for this, I would again request Fednis sir quickly to help us understand the current position as to what is the current status of the applicability of India's 104 for insurance companies, and what is the status of India's 117, which is a new standard, and the applicability of the same for the same entity, sir.
A very relevant question again. See, India's 104 is a standard on insurance contracts. Now, insurance companies as of today have not moved to India's, and the IRDA and our institute and the MCA would notify a date from which the insurance companies would also comply with the India's. So therefore, the insurance contract standards does not apply to the insurance companies. They follow the accounting guidance given by the IRDA and the general announcements made by the Accounting Standards Board. But the standard India's 104 is not insurance companies, it is insurance contracts. And therefore, any India's compliant company, if it has an insurance contract, then it is required to comply with India's 104. So 104 applicability is there for insurance companies. It could also apply to non-insurance companies. The number of companies, non-insurance companies required to apply India's 104 may be few. But academically speaking, 104 could also apply to non-insurance companies. And to that extent, 104 is applicable. Otherwise, for insurance companies, they are still not on India's, as the banks are not on India's. And 117 corresponding with IFRS 17 is ready with the institute. The ASB has already prepared it and it is ready. It is just for the government and the regulators to decide when to implement it.
Sure, sir.
Very rightly said. We have already, the institute has already referred 117 to the NAFRA, recommended, and also the amendments thereof.
Yes.
You were convening that.
Yes.
Yes, sir. Thanks for your inputs on that matter, sir. I will again reach out to Lavi, sir. And this time, this is not a difficult question for you, sir. So how non-current assets held for sale and discontinued operations?
Nothing is difficult for it.
I know, sir. Okay, sir. Yeah, so how non-current assets held for sale and discontinued operations accounted for and disclosed under AS as well as India's regime? Sir, over to you.
Simple question. I'll agree on that. Yeah. So, so Sarika, see, what happens is that in India's, as I was just mentioning earlier when I spoke, we can classify these standards as asset-based standards. You know, if it is held for the purpose of business, property, plant and equipment, capital appreciation means investment property. In that same context, you will have, in case item of asset is being held for sale, it will be classified under India's 105 called as non-current assets held for sale. This is a separate classification required as per India's 105 in case the entity has got an intention of, active plan to sell. Not only intention, the standard also says you should have an active plan to sell. And they also say that active plan to sell should mean that the sale should be possible within 1 year. Not sale should not happen within 1 year. If the conditions remain the same, it can stretch beyond 1 year also. The only thing we have to be very careful when we park it under India's 105 is that we have to stop depreciation. I think that is one of the important things which members will have to remember, right? Whereas under the AS, the AS 24, it is only discontinued operations. It only talks about discontinued operations. But these assets which are being, held for sale have been merged with the revised AS 10 on property, plant and equipment. So the revised AS 10 has taken care of those assets which are held for sale, and they don't have a separate standard in AS for that. Unlike in India's 105, wherein you have this separate classification, you stop depreciation, and the active plan to sell within 1 year, all those conditions are in. So these are the main differences between AS and India's office.
Lavi sir, in case of AS, where the assets are held for sale, do we still keep on depreciating them? As per AS 10?
Well, I'll have to get back on that, sir. I think I'll leave that for this, sir.
No, to my
No,
best
sir.
memory, even under AS10, old AS10, when the
You will have
assets were discarded, they were discarded,
Yeah.
not been put to use. There was a similar requirement to classify them and show them separately out of the gross block and account for them at their net realizable value or the carrying cost, whichever is lower. If there is a carrying cost which is higher than their net realizable value, to that extent you book that loss.
Yeah.
I think depreciation.
Okay,
So
right.
105 has more detailed principles on the same subject. As maybe in the AS, they have not been so elaborately discussed.
Yeah. Lavi sir, things may not remain the same. There's a difficult question now for you. Financial instruments, again, a terrifying concept for most of us, including myself. After so many years of introduction of this concept, some of us are mostly scared while dealing with the same. This question again, requesting you, Lavi sir, to share your perspective. How to understand this concept of financial instrument, though we have discussed a bit about it in bits and pieces in previous questions. So which are the basic standards which deal with the same, though Fednis sir had covered this, but again, as a summary, if we could, touch base on this question again, both under AS and Ind AS regime, sir.
Okay, this may take a little bit of time, so you may have to probably stretch your, the time limit for the remaining questions also. Yeah, so as we've been discussing, Sarika, what happens is that in AS 30, 31, and 32, as we've discussed till now, it was not mandated, it was voluntarily. It had the same principles which were there in IAS 39. And of course, as Fadnishi correctly said, because IAS 39 was already being amended, we opted not to go for that standard and we decided to implement Ind AS 109 because by the time Ind AS had already come in here. Otherwise, for the AS companies, they still stick to AS 13 on investments, accounting for investments, which is pretty much covering most of your financial instruments, which are in investment mode, so to speak. And as we've also discussed, since they already have a guidance note on derivatives, put together, this AS 13 and the guidance note on put together on derivatives, they sort of pretty much cover what is required for financial instruments for the non-Ind AS companies. Non-Ind AS companies, I think that is pretty much what is required. Of course, companies still had an option to go for a voluntary adoption, as I said. For example, Ashok Leyland was one of the companies that I remember who did a voluntary adoption of AS 30, 31, and 32. They voluntarily adopted AS 30, 30, right when the standard was probably in the recommendatory stage itself, they implemented it on a voluntary basis just to see what, and they've also given a very clear disclosure as to what was the impact on that particular implementation. So that is for the AS companies. Now the tough part is on Ind AS 109. See, this is a standard which even the IASB, when they amended IAS 39, they did it in 4 stages. They did not do it in 1 installment. They did it in 4 installments, which shows that even for them, it was not a very simple task. Even for them, it is not a simple task because a lot of questions came up about this classification criteria. So even as we are speaking today, if you look at how, say, for example, the banks or any of these investment entities, how they classify financial instruments, they would do it under 4 categories. It would be amortized cost, held for trading, available for sale, held to maturity. Even the RBI Treasury Department pretty much follows, this sort of a thing. The reason why they wanted to amend IAS 39 also was the fact that this amortized cost category was pretty much okay, but it was very difficult to actually define this held to maturity category. What exactly is held to maturity category? How do you classify it? And the standard had a very restrictive covenant that you cannot, once you classify, you cannot push it back again into different categories and all those things. So they did it over 4 stages. And as we have been discussing, India transitioned to Ind AS at the 4th stage of IAS 39, the 4th amendments, if I may call it, 4th amendment of this year, of IAS 39, when that 4th amendment was happening to IAS 39. So what they have basically done is that they have removed these 4 categories. They've made it only 2 categories. Many people say 3 categories, but I would still say 2 categories because it is only amortized cost or fair value. Fair value can be in two categories. It can be fair value through other comprehensive income in case of specific categories, or fair value through profit or loss account in case of, that's a default sort of a category here. And what the IASB has done and what IndAS has also done is that they have left the decision to companies to classify depending upon their business model. A very simple example I can give is like a housing finance company just gives out housing loans and collects the principal and interest by EMI, by way of EMI. That housing finance company can show all their assets at amortized cost. There's no need for them to do a fair valuation. If they are only holding it with a view to collecting the principal and the interest, what is called is the SPPI test, solely payment of principal and interest. But if the same housing finance company securitizes those loans and sells it to another housing finance company or to a bank or to an ARC, in that case, that business model changes. They will have to do a fair valuation for those bracket of loans, and they may have to present it either in OCI or in the profit and loss account, depending on what option they're choosing for. So the business model is the important driver in the case of Ind AS 109. And the business model can change. That flexibility has been brought in by Ind AS 109. Because business circumstances may not remain the same, the business model can change. If the business model changes, your classification measurement also accordingly changes. Derivative accounting has also become a part of Ind AS 109. As Manoj Fadnisi rightly said, we don't have to fall back upon the guidance note. As long as we are following Ind AS 109, the guidance note the guidance given in the standard is pretty clear. Where do you present the changes in derivatives, fair value, all those things. But I think what is probably the most significant change brought about in Ind AS 109, and this is for the larger population of members who may not, or who may be working in companies or auditing companies which have not got complicated financial instruments, is on this thing which is called as the ECL model, expected credit loss model, which has completely changed the way in which what we popularly call provision for bad and doubtful debt system. It's no longer an incurred loss model, it's an expected credit loss model. They are doing this on the basis of a provision matrix. So basically what will happen is that if we are following the ECL model in letter and spirit, provisioning should happen faster and higher. If all things remaining the same, your provisioning should happen faster and higher, because you are going to do it on the basis of what you're expecting to, a provision matrix, aging matrix, we can call it. So that is probably the most significant change brought about by Ind AS 109. It is a little bit more difficult for banks and other people who are not, the simplified model is only for trade receivables. For other financial assets, you've got a pretty complex model. We've got stage 1, stage 2, stage 3 and all. So that is a separate, we can have another separate session by itself on this, what to classify under stage 1, stage 2 and stage 3. But the principle remains the same. The principle is that don't wait for the losses to happen. Please predict what losses you have already incurred and build up a model around that. And I can tell the membership with a lot of confidence that a lot of companies, for example, L&T Finance Holdings, for example, has got a pretty robust model for ECL model. They published it right in 2017 itself. Pretty robust ECL model. They've given what are those buckets, various buckets, where the amounts are sitting and how it is moving and all those things. So that is the basic thing as far as Ind AS 109 is concerned. Of course, I will allow Fadnisi to also add on to this, but I would also like to again re-emphasize on Ind AS 107, disclosures. See, what happens, Sarika, is that the moment we see the standard, we get put off, because it's a lengthy standard. There are no illustrations, there are no photographs there. No, it is such a long standard talking about so much of disclosures. Everybody, I'll be honest, even initially I also got put off. But then when I looked into the standard for intent, when you look into the standard for intent, what is the intention behind the standard? Why do they want to give us so many disclosures? And this goes back to your earlier question about what the investors want. If you actually read the standard and the schedules together, you will be getting a lot of idea about what the entity is doing with its investments. It gives you a risk analysis. It gives you a sensitivity analysis. It gives you a lot of other stuff. The only thing which investors should probably do is to spend a little bit of time in trying to understand why those disclosures are there, and then read them along with the financial statements. That will give them a lot of value. That's what I wanted to say.
Thank you so much for elaborating in such a beautiful manner, sir. Now I'm approaching again to Fadnisi sir for.
Sarikaji, if you permit on this.
Please go ahead, sir. Please go ahead, sir.
Please, sir. Please, sir. Sorry, I missed to hear that. Sorry, sir. Please go ahead,
Chairman
sir.
is saying something. Sir, you're on mute, Pramodji.
I was just saying that you wanted to add something.
Thank you, sir. So, as Laviji mentioned, financial instruments is a big standard, and it's not possible to cover all aspects in one round of discussion. So he has touched upon the critical aspects of India's 109. So I thought I'll just add up with respect to India's 32. And 32 is the standard which gives about what is the definition of financial assets and what is financial liabilities. And that is where, if one of the major impacts which has come in on transiting to Ind AS is that preference shares are no longer equity now under Ind AS, and you need to split those preference shares into what is the equity component and what is the debt component. So preference shares were being used as structure. So if I had to borrow loan, it comes in as a debt, and instead of borrowing it as a loan, I say I'll issue preference shares to be redeemed after 5 years and will be redeemed at so much of premium. So in fact, what I'm doing is I'm borrowing money, but not showing it as debt. I'm showing it in my traditional accounting as part of my equity. And that is where India's 32 comes in place and makes you look at your financial instruments carefully and see if there is a debt component, you segregate that debt component. So 32 and 109 has really changed the way the financial instruments are being accounted for, and rightfully so, because our AS 13 has certain limitations. So financial assets being measured on historical cost globally is considered not the right way for measuring the financial assets, and therefore the fair valuation principles have been brought in these standards.
Okay. Thanks for adding a new dimension or further clarity, sir. One more critical questions out of critical question. One more critical question for you, sir. Fadni, sir. Cryptocurrency we have been hearing about a lot these days. This is a new concept, yet accounting principle in terms of a particular standard is something which is the need of an hour. So what is the plan of accounting regulators of ours to frame a specific standard or any guidance on this thing? Everybody is waiting, sir.
Yeah, we have our honorable chairman who can give what is the institute's view. I can only give my personal view.
Yes.
And my personal view, therefore, is the way the cryptocurrencies is being looked at globally is that there is no chance of banning it, but it is being discouraged, and it is to be regulated. That is the possible stand which global economies are taking. If you look at the actual trade which has taken place in cryptocurrencies in India, is a huge amount. I happened to read one of the speeches of our Honorable Deputy Governor of Reserve Bank of India, where he has given statistics about the quantum of investments which has gone into cryptocurrencies, and why Reserve Bank of India is not in favor of, coming out, and why the regulators are looking at it in terms of the negative impact which it could have. Now, as far as the accounting is concerned, today we don't have any standards for accounting for the virtual digital currencies or virtual digital assets as they are being called. So what we need to do is to fall back on the principles which are already there and apply those principles. If I have made an investment in cryptocurrencies, whether I'm holding it as an intangible asset, I'm holding it as an inventory, and those principles of the relevant accounting standards would apply to that. But given the fact that there is so much of business, now we have taxation rules also being brought in for taxing the income arising from such virtual digital assets. I think it would be in the fitness over a period of time that the accounting is also brought out, and I would urge the ASB to look into these matters, and the chairman can take a call on this. But the fact of the matter is that so many people are in this business, rightly or wrongly. I mean, I would not encourage a teenager to go and invest in a cryptocurrency, looking at the kind of risks which are there. But the fact is, so many youngsters are investing in cryptocurrencies, which is a matter of concern. And if that be so, then it is good to have the right accounting for it in place.
Yeah. Pramod sir, would you like to add?
Yeah, very rightly said by Ferdinand sir. Yes, it is not merely about cryptocurrency. It is about NFTs also. Now, NFTs are, I would say, there is no doubt they are legalized, and various of the business entities are now going with NFTs. So accounting for that, cryptocurrencies and the digital currency, which the central bank RBI would be coming out in India within this year. So all those aspects need to be taken care of, and in the board will surely see that something on that comes out after the due research. We'll surely see that.
Thank you, sir. A few questions from the participants now I'll quickly take up. Lavi sir, if actual valuation of a gratuity in a particular company is not done by a company, how do we determine its financial effect, and would only a disclosure would suffice? That's a question from one of the participants.
My first response, Sarika, is going to be that if it is not done, it's a non-compliance with Ind AS 19 and also AS 15, right? Both are mandating a actual valuation to be done. So it is a non-compliance with Ind AS. It has to come in the report as a non-compliance with Ind AS. So there's no question of providing for it on an estimate basis. Actual valuation will mandatorily have to be done. This is my the first thing. But the fact is that suppose it's a non-Ind AS company, what happens? But again, as I said, if it's following AS, then they will still have to go ahead with this particular requirement for this thing. So it's a very clear, I think this is one of the things which Pramodji and Mohammed Fadnis also said. If it is a non-compliance, please report it. There's no question of making a provision based on an estimate, right? And this question itself gives us a very good case study as to what is to be done for the purpose of reporting here in the audit report.
Lavisa, here the question actually would be that, okay, there's a non-compliant 100% agreed, but the issue is then when the disclosure is to be made in the notes to accounts, regarding the deviation, the reason, and the financial effect thereof. So financial effect, how to determine that? So in case the management is able to do so, very fine. Otherwise, they'll have to say that it is not determinable.
Not ascertained. Yeah, correct. Yeah.
So accordingly the policy. This is Fadnis sir can add, I suppose.
No, I agree with what you said that if the standard is not followed, it has to be qualified as an auditor. Company will be required to give quantify the difference. And if it has not, since the valuation is not done, that difference cannot actually be quantified, and therefore it will have to be stated like that. Because the method which is used is the project unit credit method. That requires a specific process to be followed. And therefore, if it is not done, there is no way to find out what is the possible impact of not complying with the standard. So I think the fact that it has not been done will have to be stated both in the auditor's report and in the financial statements.
Very important point. Very important. Just to add out here, that various companies and even the non-companies, they don't provide for the gratuity per se. Say in the first year, second year, third year. They say no, after 5 years.
5 years only, yeah, correct.
So, but actually it is not that way. Everyone knows that on the accrual basis, as if the services are rendered in the first year, so provision is to be made from the first year person. So that concept we all need to understand.
So Fadnis sir and Pramod sir, we had a very interesting situation recently. One company actual valuation done in 2020 as per Ind AS. Then they said pandemic, no change in employees. It same holds good, they're saying. Even 21 also. They did not go for a fresh actual valuation report, but they said conditions remain the same. Nothing has changed because everybody working from home, no change, everything has remained the same. But that really can't be an excuse for not taking actual valuation report.
True, sir. True.
It is not. Because even if there's a pandemic, there would be, unless you do the valuation, you can't say that the obligations remain the same.
It remain the same, correct, exactly.
For companies in the first year to say that my employees are just employed for the first year, and if they're not employed beyond 5 years, I don't have to pay them gratuity. But the fact is that those who are employed today for more than 5 years were at some point of time employed for the first year.
First year, correct.
Therefore, you cannot say how many of the people employed in the first year will not go beyond the period of 5 years. And that is what the actuary comes in and does that valuation. But the situation could be different if the company has a policy of not retaining people beyond a period which is less than 5 years.
Less than 5 years, yeah.
And if that is the trend which is
That
there,
is right.
company terminates it, then it is possible to give that as a valid reason for a possibility of not paying gratuity under the law. But these are exceptions, and as auditors, we need to ensure compliance with the standards. If they are not complied with, we have no choice but to qualify the financial statements.
So just one line to add. I know that we are short of time, but just one line to add that in case actuarial valuation is not done, that is one issue, non-compliance. But even if the provision for gratuity is not done and it is a material item, then the audit report would be a modified report.
Absolutely, absolutely.
One has to be very clear. One has to be very clear.
Yeah. Fredness, one quick question for you, and I'm sure we have a lot of guidance around it. So, out of your experience, if you could summarize it quickly. One participant is asking how the materiality is to be ascertained, whether some percentage or some quantum is to be taken as a base to calculate materiality for any purpose.
Yeah, it's a very important, very valid practical issue. How do you go around determining materiality? So you can take certain parameters. The turnover could be a parameter. Profit before taxes could be a parameter. The quantum of assets could be a parameter, and different entities would have different. Some companies are asset-heavy companies, so there the materiality could be on the basis of the quantum of investments in assets. But there could be companies which are lean on assets but high on turnover. So looking at these factors, one will have to decide how to determine the materiality.
Okay, thank you, sir. Lavi sir, last question for now, and then we would like to wrap it up. Though this will depend upon for what purpose we are calculating the net worth of a company, the question which is raised to us is whether redeemable preference share capital can be considered as a part of net worth of the company.
Redeemable preference share capital, whether it be considered for the purpose of net worth of the company.
Yes, sir.
Again, okay, so I think if you look at it again, we'll have to split this into an Ind AS and a non-Ind AS answer. Right? I think in the case of Ind AS, it will be converted. It will be converted into debt and equity portions. It depends, of course, on the nature of the financial instrument. But as Manoj Fadnis sir was rightly saying, Ind AS 32, compound financial instrument. It could meet the character of a compound financial instrument, in which case it will be split into its liability and debt and the equity portions. That equity portion can probably be taken as a part of the net worth. But in the case of a non-Ind AS company, I do not think it could be considered as a part of the net worth. It will only remain a debt, I think.
Yeah. So now I would like to thank everyone for the insightful thoughts what have been shared throughout the session. And I'm sure now on we would be able to better understand these concepts for the purpose of finalization of the financial statements. I'm really grateful to ASB, Pramod sir, and our renowned panelists out here for sharing their perspective in today's webinar. Further on, for final wrap-up ritual, sharing the concluding remarks, I would like to invite Abhay sir and requesting him to have, to share his views, concluding everything what is being spoken about.
Before Abhay sir says,
yes, Pramod, you would like to, yeah.
Just one line out here, that one question which was raised by various participants. We are having more than 1,600 participants, and various questions. Our questions, our panelist questions, as well as the members' questions, are still very much unanswered. And I see the response, which is very encouraging. The recording of this panel discussion would be available on the same link. It would be there on the ICI TV as well as it would be remaining on the ICI page of ASB. Soon we are going to launch the website of ASB, which would be asb.ici.org. There also it would be contained. So really it was so enlightening at the time. I don't know when it passed, but it was so useful discussion, so enriching with Fadnis sir and Lavi sir, and very efficiently moderated by Sarika ji. Really enjoyed. Over to Abhay ji for the concluding remarks.
Thank you so much, Chairman Pramod ji. And I think I should include your name also when you say that Manoj Fadnis sir and Lavi sir has responded the issues, and of course you have also summarized well in between wherever it was required. And I, personally and sincerely thank past President Manoj Fadnis ji. Actually, this topic is so technical, and of course Mohan Lavi sir also so technical that like Pramod ji mentioned that 2 hours we have discussed, but still we find that we can discuss even for few more hours. It was so interactive, so practical, and I really thank you for accepting the invitation of the ASB and becoming the panelist for very important topic today on accounting standards which are applicable to various level of entities, and including the Ind AS, and more particularly I would say the non-company entities, which has been talked about so much, that how the non-compliance of accounting standards would have an impact on the financial statements, how it has to be reported, how it has to be disclosed, non-disclosures, what are the consequences, and the Ind AS, I believe, which has been covered so well by Manoj ji and Lavi ji, that talk about.
So you have gone mute. Abhay sir, unmute yourself.
Sorry. Yes. So and we talk about 116. We talk about 109, 107. All's been covered so practically well. So I thank you so much of the ASB for accepting our invitation and sparing your most valuable time today and giving us to the participant. Thank you also so much to Sarika madam for moderating the entire session, and I think that was I would say even a value addition to this webinar, because someone who has a technical knowledge, has a base, you have covered those questions so well, and you've made understandable these questions so well to the panelists. I think they were able to respond so well. So thank you each one of you, and thank you my ASB chairman Pramod ji for always encouraging. And like he mentioned that we are also coming up with a website of ASB where we would have these recordings being hosted, and we also will be hosting on ICI TV. And would further like to add that in the interest of the auditors who would be doing audits of non-company entities, our chairman has initiated that we should go in for a standard set of accounting, where we could have a standard formats. We could guide the auditors that these are the audit reports for a non-company entities, for a small entity or medium enterprise, where we have a standard format of financial statements, how the disclosures would be done, what would be the accounting standards which will be applicable to all these companies. So we'll be coming up soon with a technical guide and maybe later with a guidance note. So thank you one and all for the patient hearing, and thank you for a wonderful session today we had. And I'm sure we'll have more such session and would take opportunities of listening to the eminent speakers today. Thank you so much.
Thank you.
Thanks
Thank you.
Also, Shalini Jindal for organizing also.
Thank you so much for this opportunity. It's been a pleasure to participate in the panel, and wonderful contribution made by everyone. Thank you so much.
Thank you very much. Thank you, everybody.
Thank you.
Thank you, Mohanji. Thank you so much.
Thank you.